All right, gang. So today we're going to actually cover the strike price. What is the strike price? If you remember in our coupon example that we could buy those chicken nuggets for $3, that $3 is a strike price. So basically, when we buy the contracts, the option contracts, they give us the right to buy a specific stock at a specific or certain or fixed price. That fixed price is the strike price. If we take a look at our options chain here, we have lots of different prices smack dab in the middle. We have strike here at the top, and all these different ledgers here have different numbers. If you notice these numbers here, they're going from low numbers all the way to high. So at the top from low, and you have to go down to go to the higher numbers. This could be a little confusing when you look at it, but just understand this, that these are strike prices. And this is where investors and traders can make their bets at these strikes. We're making predictions that the underlying stock is going to move at a certain price, so we can use it for that, which is speculation. Or if we actually really want to take ownership of the stock, as you see in this example, I have an options contract right here on the 185 strike price. If I chose to exercise my right, the seller is obligated to sell me those shares at $185. Now, if you take a look at Apple right now, it's at $245, and I can buy it at $185. That is a sweet deal. But remember, me, for my account, maybe I don't have that kind of money to be taking ownership of that type of shares, so that wouldn't work for me. Or maybe I just don't want to tie up my money and owning those shares. If you look at the bottom of the account here, I'm already at $2,600. I'm fine. I can go ahead and sell my contract and make my money, right? So that's, again, we're not trying to take ownership of shares or stocks. We're just looking to make our money off of selling the rights. So that's what we're going to do here. So the strike price, this is what the strike prices are. And if you take a look at these strike prices, now these are just random numbers, okay? And they normally go in increments of, ones or fives or tens, meaning that they're, normally $1 a piece wide, or $5 a piece wide, or $10 a piece wide. You see, I got 185, 190. That's a five wide difference there. 190 to 195, 195 to 200. So different stocks, they have different, strike prices. It just depends on what kind of stocks they are. And so, but you'll normally see them, $1 a piece, $5 a piece, or $10 a piece. And if you go to the charts, the stock itself, you see that we have prices, coming from the high down to the bottom here. And say in this case, say if I'm predicting for Apple to go up to $280 here, right? I have reason to believe. Maybe I want to go and place my strategy based off of where I believe it's going to go. And so I'll scroll down to this 280 strike. And if I believe, I have a strong conviction that that's where it's going to go, I can actually buy this 280 strike for about $7.77 if we look at the mark price. And let's just say it has to do what I said it's going to do based off my expiration, which I got 51 days on this contract series. Well, let's say if it actually goes from that price all the way up, right? So we say the 280 goes all the way up here, which this is where the current price is at. That contract that's at $7.77 will turn to $22. So that's how we make our money. So we can use those strikes, for our strategies and things like that. But that's the importance of the strikes, and that's what the strike is. These are just where investors and traders will be making our bets with these numbers here. This is the specific price that, we're buying the contracts on, basically. So this is the certain price that the definition is giving us. The certain price is the strike price. All right, gang. Catch you in the next video. Peace.